So most home buyers think that the most important thing you need to do before purchasing, as far as finance goes, is save up a substantial deposit. But what we're going to go through today is some other things, some other more important things that the lenders will actually look at when they're approving your loan. The more boring you are, the more chance you have of getting a loan. It's as simple as that. So they know that people are full of shit essentially when they apply for a loan, because the natural thing to do is say, I spend nothing, I don't do anything.
Other ones that would affect borrowing capacity is obviously credit card limits.
So even if they're unused, so you're either full of shit or you're trying to manipulate your borrowing capacity. So let's figure out which one it is. So you will then get bundled up with the desperados that are applying at 50 places in a day.
First thing is obviously spending habits and what banks are actually looking at before approving a loan.
So what I'll go through first, so spending habits, so lenders use what's called a Household Expenditure Measure or a HEM. You might hear the term HEM. Basically what that is an average spending for that couple or for that single person. So they might say a single person that's earning $120,000 per annum that lives in this postcode on average will spend $1,500, or let's just say $1,700 a month. Now that person could then put an application through us and put down that they spend $500 a month in groceries or whatever it is. The lender's still going to use that $1,700. So that's the first thing that people need to, I guess, know is what is their HEM.
And that's the thing. It's like it is based on those postcode, and people will probably be surprised on how much data the banks have on this.
They do. It's actually quite accurate. So the latest data that I received was that 85% of people are actually above that HEM amount. Yet nearly every person we speak to declares to us that they're below that amount. So do the
Which
maths
is why
on that.
banks rely on their own research and not what they're provided with by individual.
So they know that people are full of shit essentially when they apply for a loan, because the natural thing to do is say, I spend nothing, I don't do anything.
Because you are trying to incentivize the banks to approve a loan.
Correct. So what they actually look at then is, in a lot of cases, they'll get 3 months worth of bank statements. Now, they're not going to go line by line and add it up, actually saying that some lenders do. We try to avoid those ones for obvious reasons. But they're looking at different things like spending habits, like you've got your fixed expenses. So you've got your rent, you've got your things that you need to live with. But then you've got discretionary spending. So gambling, lots of eating out, lots of these things. In some cases, they can go above that HEM amount. So let's say you're spending more than the $1,700. As soon as you get above that $1,700 for spending, it's going to affect your borrowing capacity. So they're looking at general living expenses and then anything that they would consider to be on top. I've had cases where literally I've had clients buy like baby shower gifts at Baby Bunting, and then the lenders have gone through it and go, I think they're pregnant. So some lenders are very, very thorough.
Actually
and
looking at everything.
Others, if you're declaring that you do a bit of gambling and you do a bit of this, it's quite normal. And that's all factored into that $1,700. So you'd be very surprised at, how much people actually get, to spend without it actually affecting their HEM. So it is quite a lot.
So in terms of that discretionary spending and how it affects the borrowing capacity, can we put it into sort of specific terms with, say, there's a certain amount that you spend that might reduce your borrowing capacity by X amount?
Well, it depends if you're going above that HEM amount, but there is certain things that will definitely affect it. So liabilities are then expensed again on top of your living expenses. So if you've got credit cards and
babies, car loans, anything like that,
that will increase your HEM as well. So there's a household expenditure measure for a single person, for a couple with 1 baby, 2 babies, 3 babies, and then it also breaks down to how much income you earn and where you live. So there's a lot to it. Adding a child actually is quite expensive as far as
I think we actually looked at this a couple of months ago.
Yes.
And there's more specifics around numbers with children, but I think a $50,000 car loan or something, I'm not sure if it was 30 or 50,000, but that had a bigger effect on borrowing capacity than a child did. So some of the things that they will look at, I'll just quickly list them off. So high discretionary spending. So just basically buying a lot of shit you don't need. Beers, gifts, Netflix, buy now, pay later, all of the random shit.
All the food delivery apps, gambling apps, buy now, pay later. They're not a big fan of that. Obviously, shops try to sell that to you. Try and avoid it. like large cash withdrawals frequently.
Yeah, because they don't know where that money's
They
going.
don't know where you're spending it.
Yeah.
It's usually a reason people are doing that.
Yeah.
And lots of subscriptions. But again, if all of this fits underneath that HEM amount, then it should be fine. But if it is above, it can really affect it.
So would you say that they're looking at, say, discretionary spending or the household expenditure measure, they're assessing it independently if it's above the HEM, and if it's not above the HEM, they're basically applying their high-level HEM to the...
So what I've found in experience is lenders will actually look closer at your application if you've declared a living expense less than the HEM amount.
Okay.
Because they start going, bullshit.
Yeah.
85% of people are above that.
Yeah.
So show me 3 months bank statements then.
Yeah. Why are you abnormal?
You're either full of shit or you're trying to manipulate your borrowing capacity. So let's figure out which one it is.
Yeah.
So in a lot of cases, it doesn't hurt, especially if you've got good income, it doesn't hurt to sit down, actually work out how much you are actually spending.
Yeah.
And in a lot of cases, 85% of the time, it will be above that. And just declare that. And
for the people who potentially worried about declaring it and potentially above their HEM, can you look at different banks in that situation to recommend?
Yep, there's different banks. Banks also will use different buffer rates for existing debts.
Okay.
So some will add certain buffers to, the car loan that you've got or the credit card you've got. They all do different things. So it's really important that you speak with a broker before, like myself, before you start looking at lending options. If you go into, go see Susan down at the branch.
You're only getting assessed once.
Correct. She's going to look at it all, and if she doesn't like something that she sees, you decline.
Yeah.
You come to a broker. Quite often we will see these bank statements or we see these spending habits and we'll go, look, I don't think we should lodge just yet.
Yeah.
Let's wait a month.
Make a plan.
Yeah.
Get rid of this, get rid of that. Then we'll submit the
credit
application and it can almost guarantee the
correct.
approval.
Let's close some credit cards.
The next one's probably credit behaviour.
Yeah, so this is probably the number one.
Yeah.
We see a lot of the time, you can go into Harvey Norman and you get the Latitude cards or whatever, the 60 months interest free and all this shit. What people don't realise is if you miss 1 month of those payments, it gets reported back to your credit reporting company. So it's usually Equifax or Illion. So basically that goes back onto your credit file to say that you've missed a payment. Now, if you've missed that payment, I think it's for more than 1 week, it's listed on your credit file.
Okay.
That takes a huge hit out of your credit score. Most lenders need a credit score above 600 for them to even consider your application. So a couple of missed payments, lots of inquiries is another one as well. So we see this in my car loan business a lot where people think that applying at 20 different places is the best way to compare them.
And the same thing with that's home loans and or car loans or credit cards, any sort of finance.
Yeah.
That application, if it's pending or you've applied, will be a negative credit behaviour.
Because it's all based on behaviour. So someone that's desperate for money will apply at 30 different places. Yeah. But that is then also confused with people that are just trying to get a better rate or thinking that's what they need to do.
Yeah.
So you will then get bundled up with the desperados that are applying at 50 places in a day.
Yeah.
So then they look at your application and go, well, I don't think I want to give them money because they're quite desperate. Yeah. So you've got to be really careful of what you do. Again, speak to a broker.
Credit behaviour is probably much more important than your household expenditure measure.
Credit behaviour, 100%. If you're late on payments, so when your credit score is actually linked to a probability of you defaulting on that loan. Yeah. And again, very accurate. Yeah. So if you're down to, like 200 credit score, so substantially less than you need, it gives you a rating. So a rating that we see, it might say you have an 85% chance of defaulting. Yeah. And then you go through the credit file and you see all these defaults.
Probably not best to speak to a broker if your credit score's 200. But you're probably looking at a different professional.
But it's, you could also look at credit repair companies and stuff like that. But we got to acknowledge that some people do make shitty decisions but shouldn't be punished for life for it. Your credit score does repair. Yeah. So I think it goes up about 100 every month or so. Okay. If you behave yourself. Yeah. So I don't know. I think it's every 3 months it goes up 100, I think, from memory. Yeah. But that can add up,
Oh, absolutely.
Just stop inquiring.
Yeah.
Just pay your shit on time and then just let it sit.
And if anyone does have a poor credit score and they want to improve it, I'm sure a mortgage broker can still guide them on how to improve your credit score.
We can do what's called a soft touch credit report as well. It'll show us everything.
Yeah.
But it won't put a mark on your credit. So it's not us putting an inquiry in. We can pull the data out without affecting the score whatsoever.
Cool. And then other ones that would affect borrowing capacity is obviously credit card limits.
Yep. So even if they're unused.
Yep.
So this is where a lot of people go wrong. They have a $50,000 credit card.
I don't have anything owing on it.
Zero balance. So what they actually do is they use a percentage as a repayment on the limit.
Because you have access to that money immediately
you can pull it out
want
today.
You can just go and spend 50 grand.
Correct.
The next day after you applied for your home loan, you've got $50,000 indebted at a 17% interest rate.
And even though a lender, let's say you go to Big Four bank and get a credit card, the minimum repayment on that will equate to about a 99-year term.
Yeah.
Lenders, when you're borrowing, they ignore that shit and they actually put a repayment so it's paid off within a reasonable time frame.
Okay.
So I'll use $10,000 card limit as an example. They use 3.8% of the limit, so $380 a month is what's used in your serviceability. Now that could make a big difference.
Pretty conservative, really, when you think about it. When there's such high interest rates and potentially, so applying only 3.8.
So get rid of your credit cards if you can. You know, just close them down, make the limits as low as possible. You buy now, pay later stuff. A lot of them are now actually reporting through to your credit file as well.
Yeah.
So every time you apply from it's going on your credit file. It's an inquiry. They're also,
because it's not like you can use a credit card for potentially a medical emergency or any of those things that you might need to pay a bill or whatever. You're actually using credit for a specific purpose. But a buy now, pay later setup, that's probably going towards clothes or appliances or
stuff,
just random stuff that isn't going to help you get a loan. So they're probably looked at even more negatively than a credit card.
Correct. And they don't want multiple of them.
Yeah.
Having one that you buy some stuff on every now and then isn't bad. I'm not saying you shouldn't have them. Just be mindful that they can affect it.
Pay them off. If you want a mortgage, it's probably best to get rid of your buy now, pay later.
So stability is another one as well. So, they want to see that you can save a deposit over a time frame.
Yeah.
They want to see that you can hold a job for more than a couple of months.
Yeah.
They want to see that you have stability because people that have stability are usually better at paying shit off.
Yeah. Which is why they probably offer LMI waivers to medical professionals and accountants and things like that.
The more boring you are, the more chance you have of getting a loan. It's as simple as that. So it's literally most lenders will look at bank statements up to about 3 months or look at your behaviour for about a 3-month period. It's not too long of a period to actually have to behave yourself.
And I mean, you could probably apply this to an individual level. If I was looking to lend my own personal money to a friend or a family member, you would apply that reliability based on your understanding of that, friend or family member to assess the risk. So
100%.
You can understand why banks are doing it.
Yeah, you're not going to give Jimbo the crackhead down the street $50, and but your neighbour that's a solicitor, you might possibly do it if you needed it.
Yeah.
So look, to summarise what we've gone through today. Yes, a deposit is a fair amount of what you need, but they're going to look at a lot more than that. They're going to look at your spending habits. They're going to look at your existing liabilities and your general behaviours, how stable you are in your employment and so on. So if you are planning to purchase or make an additional purchase, so you've got an owner-occupier and want to purchase again, start the planning early, start working out your borrowing capacity, speak to a mortgage broker like myself, figure all these things out before you just go to an open home and fall in love with something and go, I want that house. Yeah. Because you might get, a bit of disappointment when you then come to a broker and, oh shit, you've got a terrible credit score. No lender's going to give you this. You've got late payments. Start planning early. Yeah. Biggest advice.
Maybe you should put together a how to get approved guide. Put it in the description.
Ring me and I'll do the rest. But that's it for today. We'll
see you on the next one.
Well. Thank you.